Imagine this, you are the CEO of a thriving global company. Your products are selling worldwide, your team is growing, and your profit should be skyrocketing. But because the profits you earn in one country are taxed again in your home country, your hard-earned gains are always slashed. This is the reality of double taxation. However, there are legal and strategic ways to reduce that burden and take control of your company's financial future. In this video, we will explain effective cross-border tax planning strategies that help minimize tax liabilities and the role tax advisors play.
Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of taxmobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos.
Treaty shopping. Tax treaties are powerful tools in cross-border tax planning, offering benefits such as reduced withholding tax rates and relief from double taxation. Treaty shopping involves strategically structuring international investments and transactions to maximize these benefits, helping businesses lower tax liabilities, boost after-tax returns, and streamline operations. Key elements of treaty shopping include understanding tax treaty benefits. Tax treaties typically provide reduced withholding taxes on dividends, interest, and royalties paid to residents of treaty countries, while also defining how taxing rights are shared between countries to prevent double taxation. Establishing holding companies in beneficial jurisdictions. Businesses often set up holding companies in jurisdictions that have favorable treaties with the countries where the business operates. Advisors help in selecting these locations to align with the company's operations and compliance needs. Anti-abuse provisions and compliance. To curb treaty abuse, many jurisdictions enforce measures like the Principal Purpose Test (PPT) under the OECD BEPS framework. Advisors ensure that treaty shopping structures are compliant with these anti-abuse rules, demonstrating that the holding company has a genuine commercial purpose beyond merely obtaining treaty benefits. Foreign tax credits. Foreign tax credits are mechanisms that allow businesses to offset taxes paid in foreign jurisdictions against their domestic tax liabilities. When used effectively, foreign tax credits help prevent double taxation on income earned internationally and can significantly reduce a company's overall tax burden. Here is how it works. When a business earns income in a foreign country, it may be required to pay taxes on that income in the foreign jurisdiction. If the same income is also subject to tax in the company's home country, a foreign tax credit can be claimed to offset the foreign taxes paid, reducing the home country tax liability. Maximizing credits through strategic planning. Advisors assist businesses in planning to maximize the benefits of foreign tax credits by carefully managing the timing, type, and allocation of income. Advisors also help determine eligibility for credit based on the tax character of income, as some jurisdictions provide credits only for certain types of income. Carry back and carry forward of foreign tax credits. In some countries, unused foreign tax credits can be carried back to prior years or carried forward to future years, offering flexibility in managing tax liabilities. Advisors guide businesses in tracking foreign tax credits carried forward, ensuring they are applied in the most beneficial way. Blending and pooling of credits. In certain cases, jurisdictions permit the pooling of foreign tax credits from multiple sources, which can enhance credit utilization. Advisors provide guidance on blending credits across countries to optimize their impact on domestic tax liability. Jurisdiction selection. Selecting the right jurisdiction can significantly impact a company's global tax position. Jurisdiction selection involves assessing various factors to identify the most tax-efficient location for conducting business. Such factors include analysis of corporate tax rates. Corporate income tax rates vary widely across jurisdictions, impacting the profitability of international operations. Advisors help businesses evaluate jurisdictions with low or moderate tax rates to reduce tax costs while considering other important factors like political stability, regulatory requirements, and infrastructure. Assessment of tax treaties and withholding rates. Jurisdictions with extensive tax treaties offer businesses greater flexibility and reduced tax costs. Advisors analyze the withholding tax rates on dividends, interest, and royalties across different treaties to identify jurisdictions that align with the company's operational needs and cash flow objectives. Tax incentives and special economic zones. Many countries offer tax incentives such as reduced tax rates, tax holidays, or credits to attract foreign investment. These incentives can provide substantial savings, especially in industries like manufacturing, technology, and research and development. Advisors assess the applicability and duration of incentives in various jurisdictions, ensuring the company benefits from favorable tax treatment without overlooking long-term tax obligations. Evaluation of controlled foreign corporation (CFC) rules. CFC rules are anti-tax avoidance measures that prevent businesses from deferring tax on foreign income by holding it in low-tax jurisdictions. Advisors assess whether a jurisdiction's tax regime includes CFC rules or similar anti-avoidance provisions that could limit the benefits of selecting a particular location. Intellectual property structuring. For multinational companies, intellectual property assets like patents, trademarks, and copyright often generate substantial income. Strategically managing where and how these assets are owned can significantly minimize taxes on royalties and other IP-related earnings. Effective IP structuring methods include establishing IP holding companies in low-tax jurisdictions. Establishing an IP holding company in a low-tax jurisdiction that provides favorable tax rates on royalties or exempt income from intellectual property assets allows the business to centralize intellectual property management while minimizing taxes on licensing income. Advisors ensure that intellectual property holding companies are set up in compliance with substance requirements, demonstrating that the entity performs genuine economic activities. Transfer pricing for intellectual property assets. Transfer pricing regulations require that intra-company transactions, including intellectual property licensing and transfers, are conducted at arm's length. Advisors help create compliant pricing models based on the economic value and usage of intellectual property assets. Proper documentation of these policies minimizes the risk of tax audits or adjustments and ensures alignment with global tax rules. Exploiting research and development tax incentives and patent box regimes. Some jurisdictions offer special tax regimes such as patent boxes that provide reduced tax rates on income derived from qualifying intellectual property. Advisors assess the benefits of locating research and development and intellectual property management functions in jurisdictions with these regimes to maximize tax savings. Avoiding double taxation on intellectual property income. Improper structuring of intellectual property ownership can lead to double taxation on royalties and related income. Advisors work to structure intellectual property ownership to reduce withholding taxes on royalty payments and mitigate double taxation. They also consider the impact of transfer pricing adjustments and tax treaty provisions on intellectual property income flow. In conclusion, treaty shopping, utilizing foreign tax credits, jurisdiction selection, and intellectual property structuring are critical decisions in cross-border tax planning. Tax advisors play a vital role in designing and implementing these strategies to minimize cross-border tax liability, enhance tax efficiency, and ensure compliance with the evolving landscape of international tax laws. By leveraging these strategies, businesses can optimize their global tax position, enabling them to compete more effectively in international markets. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.